Hello, welcome back everyone. Thanks for attending. And today's topic will be rate buy downs help buyers purchase new homes. We're going to reference an article provided by John Burns Consulting, a highly reputable real estate resource that monitor the real estate industry. And again, this is Si Wing Yi, and my guest host once again is Mr. Richard Advani from Guarantee Rate Mortgage. Richard has been a very successful and very long-term real estate loan consultant. He does investment loans in all 50 states. He also does owner-occupied loans as well. So welcome, Richard. Thank you for attending. You are the perfect person for me to talk about this particular topic, being a loan agent for many, many years, helping so many buyers throughout the country for so many years to achieve their goals and dreams. So without further ado, so this article again is from John Burns Real Estate Consulting, and the is rate buy down help buyers purchase new homes. So I've highlighted this short article. We're gonna emphasize the yellow highlighting, as you can see. So Richard, so let's begin by stating that let me go through the first paragraph. 75% of nationally surveyed home builders confirm they are buying down buyers' mortgage rates to make payments more affordable. The survey did by John Burns Consulting indicate that 32% of the nation's top builders are buying down the full 30-year mortgage term, and another 30% of builders are temporarily reducing the rate for the first time for the first 2 years of the mortgage. And then the remaining 13% of the builders identify other less common buy downs. So without further ado, there are two popular strategies that the builders are doing to lower the mortgage rate for buyers. One is a 30-year rate buy down, and the other one is 2-to-1 temporary rate buy down. I know the letters are kind of small, Richard. So can you go over these two loan program for primary owner occupied buyers out there? And
Yeah, absolutely. And yeah, as the article really notes, things have slowed down a little for builders out there. That's not saying there's not, multiple buyers still for every home, but they are feeling the pinch. And there's been a little bit of a dynamic shift from a seller's market to kind of in between a buyer's and a seller's market. And, the major thing that's driving that, of course, as we all know, is the interest rates, the Fed induced mortgage real estate drawback with the higher rates. Now, the way to solve that, of course, builders have realized is incentivizing those interest rates. So for owner occupied primary homes, builders, developers have an opportunity to contribute up to, excuse me, I almost need to sneeze, up to 6%. Up to 6% of the purchase price in terms of a concession to buy down the rate. Now, 6% or 6 points, as you can imagine, is a huge amount of money to buy down the rate. And oftentimes they're able to buy down the rate to, the high fours to low fives and kind of mitigate that increase in interest rates that we've seen across, nationally. So it's a really cool strategy. It also is a strategy that applies to investor loans too. The difference is that the agencies, Fannie Mae and Freddie Mac, restrict that builder or seller incentive to 2% of the purchase price versus 6% for an owner occupied home. But even then, getting that 2%, incentivizing the interest rate, getting the overall rates a little lower for us investors is also really good as well. I have been seeing more and more builders and developers also incentivizing property management in addition to the rate buy down. And that's cool because if you look at a spreadsheet on some of these newer construction properties, really the difference between a deal or no deal in terms of numbers is that management fee. And, you get rid of that, and all of a sudden these pet properties pencil out now. So, I've actually brought that up to a lot of builders and developers that we work with, and light bulbs went off for them as well, that hey, you know what, you're right, this is a great way to increase cash flow if we incentivize management for 1 to 2 years. That paired with, as the article mentioned, seller concessions towards closing costs and interest rate buy downs, it still really makes it a good time to go out there and buy real estate, especially because 6 months ago, if you wanted to buy a new construction asset, or really any asset, even a turnkey property anywhere in the country, you were buying 6, 8, 12 months later, if not even longer, sometimes 2 years out. And now you actually have an opportunity to go out there and buy a property, which it's been a while since any of us, whether as investors or primary home buyers, it's been a while to where we can say, hey, you know what, I want to buy a property this month and actually be able to close on something within 30, 60, or 90 days. And that's great. And I think whoever has been still buying in this market and realizing, as we've done in other webinars, we're dating the interest rate, we're married to the property. Whoever realizes and is taking advantage of the all of a sudden availability of inventory, they are going to capitalize. Once rates move down, we're going to refi. And that fundamental supply and demand concern that has pushed the real estate market to where it is, that has caused the Fed to react and increase rates, hasn't changed. It hasn't gone away, right? I mean, it's great that they increase rates to slow things down, but in the meantime, they should have thrown a lot of funding and money at housing starts and building new homes. That way, when they do drop rates, we're not as in as much of a housing crunch. But that hasn't happened. So guess what? Rates come down as inflation cares. Supply and demand issues are still there. All these people on the fence come off the fence. I think in the long term, 5 years from now, house prices are going to be higher than they are today. Now, are they going to do maybe a little this in the next year, or maybe not? Maybe they're going to level. But yeah, there's a potential even for maybe 6-10% decrease. But I don't know about you, C-Wing, but and I don't know about everyone listening, but most everyone that I encounter, myself included, I'm not property for a 1-year exit strategy or 2-year exit strategy. Most of my exit strategies are 6 to 10 years out. And, I still feel confident as real estate being a good investment, but being a huge and a good hedge against the rampant inflation we are experiencing. And supposedly now they got it down to 7%. We all know, it does feel a little better, right? We all know it feels a little better, but, I think we all know inflation was probably 25 to 30% for a long time, and now it's down to 7, probably 10, 12%. But that doesn't erase the inflation that's already happened, right? Mm-hmm. I mean, this is the new status quo. It's just about the amount of inflation moving forward. Inflation is going to continue to be an issue as we continue to print money. So, what better than a hard, tangible asset like real estate? Nothing. Paired with the fixed rate, even in the 6s or 7s. Still a good hedge against inflation, still the best hedge against inflation. People say, well, what about gold? Well, I mean, sure, historically it's a good hedge against inflation, but I don't know, I asked those people tracking gold values the last 2 months or 2 years or 6 years, and you want to talk crypto volatile. I mean, gold is pretty volatile as well. It can gain 20 or 30% of its value in a couple months. And that happens again and again and again. You don't see that with real estate. Yeah, that can happen over years and years and years and be prolonged, but you're not seeing this swing like this, this many times in a year. So yeah, long answer.
I mean, I totally agree. I totally agree with you, Richard. I mean, you and I are very optimistic for real estate over the long haul, and this unique small window of opportunity of builders throughout the country are providing to buyers out there. These great incentives is really very attractive, and for those of you out there who are not taking advantage of these great incentives, I mean, you're going to be missing the boat. So for homeowners as well as for investors, by buying down the rate, you can cash flow better, and it just makes so much sense in every aspect. And there are more incentives. So let's continue with this article. So 30-year rate buy down or 2-to-1 temporary rate buy down, both program makes sense. And I heard from you that you are doing these loan programs for your buyers as well, with respect to new construction homes in various markets in the country. So good for you. So you have a firsthand knowledge about what's going on with this great incentives. So let's look at the regional differences. The percentage of builders actively using the rate buy downs. John Burns has segregated, categorized what region of the country where the builders are providing more incentives versus what what areas of the country that does not necessarily. So the builders in the Southwest, Texas, Southern California, Northern California, and Southeast, almost 80% of the builders are providing some form of a rate buy down and other incentives. And nationwide, 75% of the builders are doing that. And then the areas that are not providing as much rate buy down as incentives are mainly they highlighted Florida, and I think I know why Florida, because Florida builders does not need too much of a rate buy down because the Florida real estate market has done so well that the builder does not need any more incentive, because Florida is a very robust real estate market, especially for investors, real estate investors that you and I, including myself, actually, I'm about to close an escrow on a property in Ocala. Finally, in a couple of weeks, everything's doing well with there. So I'm very happy, to buy in the middle of this nice pandemic uptick. So you have any kind of thoughts as to why this region in the U.S. The builders are providing so much rate buy down and incentives, whereas in the Florida and Northeast and parts of Midwest, the rate buy down are not as prevalent as in the other part of the market. Any quick comment on that, Richard?
I kind of side with what you're saying. I think it's supply and demand related, and the demand is still so strong in places like Florida that they don't need to incentivize purchases. And yeah, I think it's a pretty vanilla answer why, and it shows obviously why there's huge buying opportunities in the Midwest and other places with those very strong incentives. Now, Florida may follow suit. They just haven't needed to yet.
Exactly. So as the last remaining 10 minutes or so, let's go over the details as provided by this John Burns consulting article explaining the rate buy down. So Fannie and Freddie limit temporary rate buy down to 3 years, and the rate cannot step up more than 1% each year. So therefore, again, we're going back to the 3-2-1 buy down program, where the rate is reduced to 3% below market in the first year of the loan, 2% below in the second year, 1% below in the third year. Then the year 4 to 30 revert back to the market rate, and a buyer has to qualify at the contracted market rate. Whereas a 2-to-1 rate buy down, the rate is set at 2% below market rate in the first year, 1% below market rate in the second year, then reverting back to the market rate for year 3 to year 30. Whereas FHA and VA loan buyers follow the same limitations. So what were your thoughts on this particular paragraph, Richard?
It's a really cool program. It allows you to have those inflation rates that we had, or close to them, but also, it steps up gradually. So obviously, hopefully you have increases in income and so forth. But also, by the time it reaches its original interest rate, the non-teaser rate, rates probably will be lower, and you'll be able to refinance it at that point and, hopefully lock in something similar to what you're paying that teaser rate at the time.
Yeah. So from a high level, I don't know, this is too much details down here on this graph. I don't want you to go over all the details of the numbers of the graph, but typically, can you give an example of a rate buy down? How much does it cost for a buyer? How much upfront cost they have to put above and beyond what a loan would cost to justify a rate buy down? How much costs a buyer to get that?
Are you referring to if the seller was not covering it?
Right.
Yeah, I mean, if the seller, a point is a percent of the loan amount. So, if you're talking about a $200,000 loan, for example, one point is going to be $2,000. So it could add up to quite a bit. Excuse me. Especially given that points are, typically people are paying over 2 points in this market. So, points can add up to $4, $5, $6,000 depending on the purchase price. For primary home buyers, even more, right? Because if you have an $800,000 loan on a home in California, 2 points on that $16,000. So, it could definitely add up to quite a bit of money.
Yeah, for buyer, it doesn't matter owner occupied or real estate investor. So how would one derive such decision to put up additional money to buy a rate buy to go with a rate buy down versus a straight 30-year fixed rate mortgage without any kind of rate buy down? What is a determining factor to make an informed decision?
You always want to buy it down in this market. Some sort of buy down, but the way you really determine your return on investment for your buy down, or if it makes sense, is you calculate what your current monthly payment is without the buy down, of course, and then the cost of the buy down versus how much it lowers the monthly payment, right? So if it's going to cost you 1 point or $2,000 to lower the rate by 0.5% for the duration of the loan, and it lowers your payment, let's say by $40 a month. Well, guess what? That first year, you're going to make $480, almost $500 of that $2,000 in points. So by year 4, at that point, you would have broken even on your monthly savings versus the cost of the point. And, that savings now is going to roll forward for the remainder of the loan for the remaining 26 years. So, it's cool. It's a really cool tool. I wish we had the option to pay points on other debt, consumer debt, on car loans or credit cards. Imagine if you could buy down the rate on your car loan. The savings are immense. So yeah, it's a great tool that's available to us as consumers.
Yeah, Richard, yeah, very good, simple explanation. Thank you for that clarification. Now, among my real estate investors in the past few months, the builders that are providing this type of incentive, based on my experience with my investors, and I'm sure you have similar investors, have a similar experience in that I have builders in my network market in Southwest Florida, Cape Coral area. They are doing a lot of this type of incentives and rate buy down, and also in our central Texas market in San Antonio and outside Austin Metro, we have a number of builders they're doing this kind of rate buy down for investors. They are paying part of closing costs. They are lower their price by 5 to 10%, even more from their original selling price, and a few other things. So very, very amazing incentives. And a couple of my investors closed escrow in Cape Coral recently, and they have such a good deal, multiple incentives, not just the rate buy down. So and they're happy. We have some very happy real estate investors recently, as a matter of fact, that are using this type of incentive. I know this is a small window of opportunity. It's not going to last forever. So, Richard, at what point in time before I know it's hard to predict the future, but how long do you think this type of incentives and closing costs pay off, and reduction of prices will continue before the builders will completely shut off this great benefit for home buyers and investors alike? What are your projections?
It just depends on when when the interest rate kind of pendulum swings and supply and demand, and the demand increases. So, my hunch is, once rates start moving down, they already are down, 0.5% plus from the highs that we experienced a couple months ago. But, moving into the next 12 to 18 months, I think rates will start moving down, and, these incentives will start reducing. But also, even with where rates are now, I think people are settling now in terms of where the market is and where rates are. There was a lot of shock value initially, and people are still reevaluating purchasing. So I think once some of that initial fear and shock wears off, as it is now, more people are going to re-enter the market. And, so if I was to guess, I would say we have maybe till middle of next year, best case. But that's just my opinion.
Yeah, I agree. I mean, there's a lot of in fact, maybe our next Zoom between you and I, we can talk about the Federal Reserve. We talk about the Treasury, the 10-year Treasury bonds rate, and lot of good positive predictions by many resources that tells people that things are getting better, inflation is subsiding, and the interest rate is slowly going to do a gradual decline. So all positive metrics moving forward for the real estate market. So I'm feel you and I, we feel very, very positive because we focus on real estate investors, and if you have a long-term buy and hold, 10-year or more, things will correct itself. So we continue to buy. You and I personally will all continue buying even at this challenging market because we know the deal, we know what's going on. Anyway. So any kind of final thoughts on your part before we'll finish up?
Just really, understand and appreciate what inflation really is. If you're sitting on the fence and waiting and you have money in a low interest bearing account, inflation's been like 20 or 25%. So, you had 200 grand in there, guess what? While you're waiting, you lost 50 grand at least just this past year. And the inflation is going to continue. So find some hard, tangible assets that are a good hedge against inflation. And, if you're not, don't worry. There's a lot of us that are still scooping things up. So it's going to be, obviously easier for us to build wealth, but factor that in. We're in a very high inflationary period, and inaction is costing you money. I would rather take a 1% ROI or 2% ROI on a new construction property front end versus, losing 8, 10, 15, 20, 25% to inflation. So get off the sidelines, educate yourself, don't make rash decisions. But I think once you educate yourself, you'll see that real estate still proves to be a very good long-term investment.
Well, Richard, I totally concur with you. Thank you so much for your great insight and investment philosophy. Thank you so much, Richard Benny from Guarantee Rate Mortgage. Thank you once again, everyone. Thanks for watching. We will see you guys next time to talk more about real estate investing and opportunities. Thank you so much, Richard. Have a nice day, everyone. Bye-bye.